You may have recently received your investment statement in the mail, and it's been frustrating. We had a tough year in 2022, and your portfolio is probably down. But what do you need to focus on, just last year or over 2, 3, 5, 10 years? In this video, I want to break down and show a statement, how it works, and what you should be looking at when you look at the statement. So, the problem is a lot of you get the statement and you look at your 1 year number. And the thing is, you need to look beyond 1 year. We know that the stock market doesn't just go straight up. There's bumps along the way. It's important to note that it's a long-term goals of the portfolio that really matter. How have they done in the past and how are they structured going forward? So I want to share a statement. Now, this is an actual client of ours. Obviously, I've removed all their information on here, but this is a client of ours that's been with a BCV Asset Management. So one of the portfolio management firms that we use for our clients, and they've been there over 10 years. And this is a perfect type of statement I want to go through with you. And it really comes from having conversations the last couple of weeks with a lot of you that have received your 2022 statements and you're down. And you talk to your advisor and your advisor says, yeah, 2022 is rough. And you go back and say, but how have I done over 3 years, over 5 years? And the answer isn't too different. So I want to make sure that you're looking at the right number. So let's quickly look at an actual client portfolio here. And again, you'll see here on the screen how they've done. Now, again, a 1 year period, they're down 4.8%. So if you got your statement and only looked at last year, you'd say, well, I need to do something different. I'm down 4.8%. That's obviously a loss. Now, this is net of fees as well. So this is after fees, they're down 4.8%. Now, some of you might be saying this, saying, oh, I wish that was my portfolio. I'm down 20, 30, 40%. And that's definitely some of you. Now, when I talk to this client and all of our clients, I'll say, look, we want to look how it's done and compared to the market. So again, we run statements where it compares it to the S&P TSX, the bond market, as well as S&P 500 total return. So you need to compare it to something on a 1 year and beyond. So, okay, we're down 4.8%, but the market was down quite heavily last year. Now, what's our 3 year average? Now, if we look at a bigger, and this is where we need to take our blinders off. A lot of us are locked in on blinders. And if you get your portfolio statement and your view is like this, if your view is narrowed in and I'm only looking at the last 3, 6, 12 months, you're missing out. Things can fluctuate. You have to look beyond that. And this is the point of this video is you really need to change your mindset on when you get your investment portfolio. So if you're someone that got that portfolio and you look at your statement, you're like, I'm down 4.8%. Let's open up the blinders a little bit. 3 year average. So again, if I look at a 3 year average return, this client has received 8.2% per year on average for the last 3 years net of fees. Now, that's a good return. Again, we usually try and target 6, 7% for our clients based on, this client for his portfolio. And now if I stretch it out even further and look at a 5 year average of 8.2%. So again, consistent. Their 3 year average, their 5 year average, their 10 year average is quite good, probably a little higher than it should be based on this is just a blue chip dividend portfolio, but it's averaged 12% net of fees every year for the last 10 years. This is where I want to challenge each and every one of you watching this video in your 1 year number may not look great, but how does your 5 year number look, your 10 year number, or your 3 year number? Again, everyone's going to have different things, but what does that look like for you? Are you making money? If your advisor, your investment person, whoever you're dealing with, if they say, well, yeah, we didn't make money last year. Yeah, the 2 year number is about break even. The 3 year number, you've averaged 1% rate of return. Well, now you get a better feel for it. Again, 2022 was bad, but 2021 and 2020 were pretty good times in the market. And as you can see from our client portfolio, they've still averaged at 8.2%. So yes, last year is going to be a tough one. You're going to have probably a negative performance. I was talking to a client just yesterday, and he was saying, look, him and his wife run separate finances, which I don't, encourage. If you can combine, definitely it's a good thing for your family finances. But they ran them separate. They always have. He's been a client for many, many years. He invests with BCV, and then his wife invests elsewhere. Conservative investor, and he's like, yeah, she made 8% last year. And so I'm still waiting on the portfolio. But yeah, typically most people, whether you're in bonds, again, if you look at that bond portfolio, it's down. Bonds lost, equities lost, real estate's down, pretty much everything across the board. And that's why you need to open up that blinder and look a bit further to make sure that you're actually doing better over a 3 and 5 year period. Now, if you find my 3 and 5 year period aren't much different than my 1 year period, Well, it's time to then dig in. Is there a change within the portfolio that you need to make? Do you need to look for an different investment person altogether? Again, your portfolio should look like this. I'm not saying the return should be this because everyone has a different risk level and structure and all that. But just because your 1 year number is low doesn't mean your 3 and 5 and 10 should be low. In fact, it should be 5, 6% or a little above. That should be your average 3 to 5% return. Again, it's all going to be dependent on your risk. You need to understand, how much risk do I have in my portfolio? How is my portfolio structured? What are the fees? A lot of you I talk to, you're paying 3% in fees. Well, if you're only getting 5 and you're paying 3 in fees, you're not left with much at the end of the day. Again, if you're paying reasonable fees and you're getting a really good service on the investment and the planning side, then it's worth it. I talk a lot about that on the channel. It can make a lot of sense. Paying for advice is worth it. Paying for non-advice obviously is not worth it. And again, a lot of you have gone from kind of the mutual fund bank world to DIY, and you've skipped this planning advice in the middle. That planning advice is a sounding board at times. A lot of our clients, the value they get from us at times is when the market's down. Again, this client, I'm down 4.8%. Should we change up the investments? Am I on track for retirement? Do I need to change my cash flow in retirement? And the reality is we look longer term. Look shorter term for cash flow. So when you build out your retirement plan or a financial plan, look at your cash flow. So if you're getting close to retirement or in retirement, what do you need over the next 1, 2, 3 years? Ideally 1 and 2 years. Make sure that cash flow is ready to go, that you're not liquidating when your portfolio is down 4.8%, or for some of you, 15, 20, 25%. It makes a big difference. So make sure that you're structured properly. Again, if the portfolio hasn't performed the way you want it to, you need to have that tough conversation with your investment advisor. If you're your own investment advisor, DIY, maybe it's time to go back and look for a portfolio manager to help you out through this process. But let's say you work with an investment advisor, someone that's helping you choose, mutual funds, ETF, stocks, whatever it is. There's a plethora of options out there. You need to have that tough conversation to say, over 3 years, over 5 years, I've averaged less than 5%. Like, why is this? What have we been invested in? What's hurt us? What changes can we make? Those changes, they might be able to be made in-house. They might, you might have to make that tough decision to say, look, this relationship isn't working anymore. I need to find something that works for me. At the end of the day, it's your money. You need to make sure that your money is working for you, but you also have to be realistic to the amount of risk you're taking, to how it's structured, all of that. I think some clients some clients come to us and they're unrealistic about what they should be getting ready to return, how much risk they're taking. I have clients all the time. Look, Adam, when I talk to BCV or the investment firm that you deal with, I don't want to take much risk, but I'm looking for a double-digit return. Okay, those two things don't go together. Maybe you've had a good run. That world is not here anymore. So you have to be realistic. But again, if you're wondering, okay, Adam, where should my rate of return? If I'm a balanced to growth investor, anywhere from 50 to 80% stocks, the rest in bond or fixed income, what should my 3-5 year return be? I would say it should be north of 5%. That's typically what we see. Ideal a little bit higher. Again, this client's 70% stocks, 30% bonds. They've received a bit better. Again, when I look at this and say, okay, well, your 3 and 5 year averages are 8.2%. Your 10-year average is 12%. Like, the 12% is a little high. I don't like to push that, but again, 8.2%, that seems reasonable. Half of that they're getting through their dividends, half of that's just growth on the stock. So now's the time to go back to your portfolio, review not just the 1 year. You'll get frustrated if you just look at the 1 year. So make sure you're looking at the 3 year, the 5 year. If you've been there for 10 years, how's it working? Have that tough conversation with your advisor. And if you're not sure, kind of, okay, I've done DIY and I'm doing good. Like, the portfolio's kind of ticking along and I'm making my returns, but I'm not sure, like, cash flow, how to structure that. If you need help with the financial planning side, that's where our firm comes in. There's a lot of fee-for-service advisors out there. Go look for one. We've done a series of 5 videos on what a good retirement plan should look like. We'll link that video below.